A stock exchange is a share market or bourse is an organized market which provides trading facilities for stock brokers and traders to trade shares of the listed companies and other financial instruments such as term finance certificates and derivatives. Stock exchange provide facilities for such as for the issue and redemption of securities and other capital events, including the payment of income and dividends. What are shares? Shares are the many equal parts into which its ownership is divided. They can be bought by individuals as an investors. Objective of stock exchanges, the primary purpose for which the company is to be publicly listed at the exchange is to cost effectively raise capital. It reduces companies' reliance on the traditional finances, institutions, individuals. Listing allows business expansion without increasing borrowings or draining the company's cash resource. Listing companies may convert to public ownership, become more successful than private controlled companies. The IPOs, initial offering of stocks, companies grow faster than controlled companies. After going public, both public-private companies must disclose financial information to regulators. Each shareholder is a partial owner of the company in which they bought shares, and investors can buy and sell shares on the stock exchange. Companies on incorporation issue shares, equity, and later, perhaps when they are building a business, original shareholders might still own them. They may have sold them to someone through share market. If company makes profits, shareholders have some of it passed to them in the form of dividends. The amount divided varies over the years depending upon the profitability, how much money directors, company, and management want to keep as reserve for future expansion. Participate in stock market. Directly, buyer and seller buys and sells shares. Indirectly, through a collective vehicle, shares are grouped together such as mutual funds or exchange-traded funds. IPO done in the primary market and subsequent trading is done in secondary market. IPO initial offers sale by company of shares of its stock to the public in financial market. Book building process. Price, discover and pricing a new share issues. An underwriter attempts to determine at what price to offer an IPO based on demand from institutional investors for efficient price discovery based on actual supply and demand by informed investors. In India, BSE, Bombay Stock Exchange, existence in 1875. NSE, National Stock Exchange, founded in 1992, existence in 1994. BSE is the oldest stock market, NSE is the largest in volume, more liquid market. Both compete for order flow that leads to reduced costs, market efficiency, innovation. The presence of arbitrages keep prices in to stock exchange within tight range. The timing is 9:50 a.m. to 3:30 p.m. Indian Standard Time, Monday to Friday. Buyer and seller are kept as anonymous. 30 PSUs and 45% free flow market capital in BSE. Nifty 50 shares and 62% free flow market capital. Foreign institutional investors, sub-capital investors, FDI participate daily in operations. Trading mechanism. Trade in both exchanges take place in an open electronic limit order book in which order matching is done by the trading computers. There are no market makers. Entire process order driven means investors place orders automatically matched with the best limit order. Buyers transparency display all buy and sell orders. All buy and sell orders in trading system in the absence of market maker. No guarantee that order will be executed. All orders in the trading system need to be placed through brokers. May provide online trading facility to retail customers. Institutional investors take advantage of the direct market access option in which they are trading terminals provided by brokers for selling and placing orders directly into stock market trading system. Settlement and trading hours. Equity spot market. T+2 rolling settlement. Any trading made on Monday gets settled on Wednesday. All stocks, for example, traders take place between 9:55 a.m. to 3:30 p.m. Indian Standard Time, Monday to Friday. Delivery of shares made dematerialized form. Each exchange has its own clearing house for which assures all settlement risks by seeming as a central counterparty. Market indexes. Sensex, Nifty are the prominent indexes. Sensex is the oldest index for equities, have 30 shares. Firms are listed on BSE. 47% of indexes free float market capitalization. It was created in 1986. Another index, Standard and Poor's CNX Nifty. Time series data made in 1979 with 50 shares including on NSE represent 46% of its free float market capitalization created in 1996. Provide time services data from July 1990 onwards. Market regulation. The overall responsibility of the development, regulation, supervision of the stock market rests with the Securities and Exchange Board of India, SEBI, which was formed in 1992. An independent authority consistently tried to lay down market rules in line with the best market practices. It enjoys vast powers of imposing penalty on market participants in case of breach. Who can invest in India? India started permitting outside investors after 1990. Foreign investment, foreign direct investment, foreign portfolio investment. All investment in which an investor take part in day-to-day operations and management of the company are treated as foreign direct investors, whereas investment in shares without any control over the operation are traded as foreign portfolio investors. For making portfolio investment in India, one should be registered either as foreign institutional investor or as one of the sub-accounts of the registered foreign institutional investors. Both registration are granted by the market regulator SEBI. Foreign institutional investors mainly consist of mutual fund, pension funds, endowments, sovereign wealth funds, insurance, banks, assets, management of the company. At present, in India, does not allow foreign individuals to invest directly into stock market. However, high net worth individuals whose net worth is $50 million can be registered as the sub-accounts of foreign institutional investors. Foreign institutional investors and the sub-accounts can invest directly into the stock listed on any of the stock exchanges. Most portfolio investment consists of investment in securities in primary and secondary markets, including shares, debentures, and warrants of the listed companies or to be listed on a recognized stock exchange in India. Foreign institutional investors also invest in unlisted securities outside stock exchange, subject to the approval of price by Reserve Bank of India. Finally, they can invest in units of mutual funds and derivatives traded on any of the stock exchange. Foreign institutional investors register as a debt only. Foreign institutional investor can invest 100% of its investment into debt. Other foreign institutional investors must invest minimum 70% in equity and balance 30% in debt. Foreign institutional investors must be special non-resident rupee bank account in order to move money in and out of India. The balance held in such an account can be fully repatriated. Restriction, investment, ceilings. FDI limit prescribed by Government of India and different ceilings have been prescribed for different sectors. Government is increasingly the ceiling progressively. FDI ceiling mostly fall between 26% to 100% range. By default, maximum limit for the portfolio investment in a particular listed firm is decided by FDI unit, which prescribe the sector to which firm belongs. Two additional restrictions on portfolio investments are aggregate limit of foreign institutional investment include sub-accounts of any particular firm fixed at 24% of paid-up capital. The same can be raised up to sector capital with the approval of the company's board and shareholders. Secondly, investment by any single foreign institutional investor in any particular firm should not exceed 10% of the paid-up capital of the company. Separate 10% ceiling on investment for each of the sub-account of foreign institutional investors in any particular firm. In case of foreign individuals, corporations investing into sub-accounts, the same ceiling is 5%. So regulations also impose limit for investment in equity-based derivatives trading on stock exchange. Thank you.